one of your investing habits is investing in yourself. If you're in a healthy investment world, you have healthy lifestyles, you have a healthy value system, and those things kind of all work together.
I believe in the stock market and I believe in our core satellite strategy, but I don't believe that I'm smart enough to pick every stock.
If you put some money in the market and it doesn't work, and you put some more money in the market, it doesn't work, you got to stop and say, what do I need to adjust? You just don't keep doing the same wrong thing.
Yeah. You are getting fired. It's just a matter of when the new president comes in, because they always bring in their own people. It's just what happens. I'm saying you be clear on where you are now. Where do you want to go?
And people should know that you do these podcasts because you like to help people. There's a reason when you go into surgery that you're okay with a surgeon that's 50 or 55 years old.
So if you could go back and give your younger self financial advice, what would it be? Thank you for joining PlanAssist Podcast, where we help people make better financial decisions. And we interview people who have been successful and or are experts in a particular area. Now, as most of you know, PlanAssist is built on 3 core principles: have a plan, be diversified, seek counsel. And so as we do these conversations, I don't force those kind of points into the conversation, but we may spend more time on any one of those or not even touch on one of them, depending on the person's expertise, background, and kind of what they want to talk about. Today, I am super excited to welcome Patrick McGorisk. He's an owner and one of the biggest owners of H&R Block franchises in the country. He's up in Michigan. He and I worked together when we first started our careers out. So I started my career out on the floor of the commodity exchanges and then moved into stocks and bonds. And that's when Pat and I actually crossed paths, where we started kind of mid-'80s into the stocks and bond business. And then our paths ran parallel for 10 or 15 years. And then he went off and started an H&R Block tax franchise and then expanded that. And then I stayed in the financial services business and started Core Wealth Consultants. When I started Core Wealth Consultants, he was one of the very first people that I called. I called and really, really treasured his advice, his input. As all of you know, the third principle is seek counsel. He and I must have talked 2 or 3 times a week about getting up and running, because I started with absolutely nothing and had a lot of challenges, as most new businesses do. And I really, really appreciated his authenticity and his input and his counsel as I kind of built that through. So with that, did I miss anything, Patrick?
Well, I would say it's been a joy to know you for over 30 years, and that we've not only grown professionally, we've grown older together, but we've grown our families together, and we've seen each other change careers, work through issues and problems. And a couple things come to mind is, if I only knew then what I know now, we would have done a couple things a little different, just a couple of decisions. And I'm old enough now to realize I don't know what I don't know. And it's pretty good to ask somebody who knows, to your point, that seek counsel, because you just don't know what you don't know.
Right.
And we're so dumb that sometimes it's tough to figure that out. So I cherish you as a friend and a comrade and a great source in helping people find their way in the investment world.
That's awesome. So that's a great way to get it started. So let me start with what I do in all these podcasts. I start with the same question. So if you could go back and give your younger self financial advice, what would it be?
Well, I think that when I look back at financial advice, and I made that point, if I only knew then what I know now, had I had a plan, had I had some habits, some investment habits, and a discipline, just those 3 simple things, and I executed on those, maybe you and I aren't having this conversation, because we'd be multi-millionaires and we wouldn't have had the wars that we did. And it's almost like it flows into life, is that if you're in a healthy investment world, you have healthy lifestyles, you have a healthy value system, and those things kind of all work together. And it's not haphazard that people find their way in rabbit holes because of their bad habits. And it's just like that financially. So I remember early in my career, I was working with you, one of the world's first discount stockbrokers. And I opened an individual IRA annually every year and put 2 grand in it because you could do that. And two of the first stocks I owned were Microsoft and Apple. The very first two stocks I bought.
Oh my
And
gosh.
this is the 80s.
80s. Yeah.
Yeah.
No, it's mid 80s.
80s.
I remember we were working. Yeah,
Yeah.
it's 85,
And
86.
I was so smart back then that when they went up 50%, that that had to be it. I
Exactly.
mean, what goes up more than 50%? Maybe 100%. And so, of course, I sold them and bought some dogs, and the 2 grand became 2 grand forever.
How many clients, and for those of you listening to this call, back then there wasn't financial planning. We were basically stockbrokers, right? And so this question makes sense for those of you who understand kind of back in the day when we sell stocks. How many clients did you talk out of buying Microsoft and buying Everex?
Oh
Do
my
you
goodness.
remember that conversation? I'd have people call in, say, I want to buy Microsoft. And I'd say, that might be okay, but here's the real stock to own. And I'd
Yeah.
literally talk them out of buying a once in a lifetime
Dell.
investment. Huh?
Yeah. I mean, well, actually, we had
I
research
built
report, we had research reports on Dell Computer and Everex.
I
Yeah.
have literally post-traumatic stress from it. That's
Mhm.
why if someone asks me what stocks I should buy, I literally say I have no idea because don't trust what I say because I'll put you in the absolute wrong stock. I believe in the stock market and I believe in our core satellite strategy, but I don't believe that I'm smart enough to pick every stock.
No, but if we would have picked a basket, if
Exactly.
if we had the discipline to pick the basket and the habit to continue to put money in to the basket and to leave it alone, to
That's what it is.
to understand the time value in the market.
Yes.
It's so hard to get somebody in their 20s to slow down. To it's I tell my kids are all early in their investing careers that there's a reason when you go into surgery and it's a critical surgery that you're okay with a surgeon that's 50 or 55 years old. Because if he has a bleeder that pops up, he doesn't panic. He says, "Hand me the forceps and some sutures." He fixes the bleeder and finishes the surgery
Yes.
because he's seen it dozens of times. Where when you're young and the market gaps down or gaps up, you just don't know that this happens all the time.
And you don't understand, I'll explain to people. I owned Amazon late 90s, right? So 96. I bought it for a bunch of different reasons. Mostly that isn't what caused it to go up, but that aside, I put 2,500 bucks in Amazon. Okay, 1997, 98. That stock went from $2,500 net worth to over $30,000. Okay, that's how much it went up. But what people don't realize is then in '01 came along and that stock went from $30,000 to $1,000. I went from a $27,000 profit to a $1,500 loss. And when I was talking to people about it, they were like, "You're the stupidest person ever." And I said, "I have no idea," but because I had learned early in my days of investing, so it really didn't wind me up because I'm like, the reason I bought Amazon hasn't changed.
Mm.
So I'm still holding it. But my point to tell that story is having rules and having those baskets of stocks and then just holding on to them is the only way to build massive wealth. You can't time it because if you time it, you have to be right twice, right? So now you got to be right to sell it, and now you got to be right to buy it back.
And one of the things that you and I have learned, certainly when we started early in Core Wealth, was the value of having something or somebody in between you and the money, something that stops the immediate decision. And I recall specifically during the financial crisis in '08, being in in one of the tax offices that I bought, and I was still active in the investment world, and a retired husband of one of our tax pros coming in. He was a sheriff, and he had been saving his entire life. And the market was gapping down for what, weeks, it seemed like, during that financial crisis.
18 months,
Yeah.
basically. I mean,
And he came in and he said, I sold everything. He couldn't stomach it. And my stomach turned over. He just got out of everything.
right.
And literally within 18 months, things had recovered significantly. And the emotions of the moment and the lack of a plan and the lack of somebody in the middle of, even if he would just sold part or had a conversation, to have something to say, stop, take the emotion out of it. Does this make sense? And maybe it did, or maybe it didn't. But the point is that to have that advisor in the middle to say, well, let's think twice about doing that. And I've experienced people making emotional decisions with their money that have turned out to be some of the worst decisions that they made in the long run.
And when I came up with the principle of have a plan, so let's just spend a few minutes on that and we'll kind of just bounce through these. But when I came up with the principle of have a plan, what you just described is exactly what I had in mind. Because when I talk to people, it's very important that they've written down, and I'm not talking about a 40-page PDF document that they have printed off by some life insurance person that wants to sell them life insurance. I'm saying you be clear on where you are now, where do you want to go, and then how's investments. It's kind of like if you're building a house, you're extending your house up at the cottage, right? Well, the first thing you're going to do is dream, and you're going to have some views, and here's what I want to do, and you'll talk to Denise, and you'll have some opinions about it. Oh, that's good, right? But at some point, you're going to get an architect. I don't know if you've gotten it yet or not, but at some point you'll get an architect. And then that architect will do a bunch of stuff. And then there's going to be one more step that's going to be insanely painful, the engineer, right? So now all of a sudden the engineer shows up and says, no, we got to do this or do that. Now, sometimes you don't realize that the architect, because the architect and engineer work so closely together, you don't know that they've made some adjustments. But if you've done it where you hired the architect and then went and hired the engineer, you will see a lot of adjustments, because the engineer will say you can't have an open roof 14 feet, 15 feet wide. You have to have a hole in the middle, right? And then once you've built that plan, right, at that point, you're really not looking at that plan almost at all, right? It literally goes into that little box that you do it. And what you're doing every day is you're looking at one page. You're looking at, let's just do the foundation. Let's just do the walls. Let's just do da 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 da. And that's my point when I say have a plan. I'm saying you should have some big kind of view of where you're going. You're the sheriff. I want to retire in 10 years, but this money I don't need in the next year or two. But what do you need in the next year or two? Then that becomes your focus, right? I mean, so the plan that I'm talking about is what is your main focus over the next 6 to 8, 9 months? And then do those, and then do it again, and then do it again. And all of a sudden you'll wake up in 10 years and be just stupid rich.
Well, there's so many analogies that you can use to paint the picture. It's the plan is a process, and that you make adjustments as you go. So if you and I are driving coast to coast, we get out Google Maps and we plan our route. Well, once we get into the foothills of the Great Divide, if we hit a snowstorm, we adjust.
That's right.
And we might take a different route. The market might be gapping down. There could be some political event. There could be some geographic turmoil. Who knows what? It could be artificial intelligence creates this great boom. We don't know, but we have a basic plan, and then we make an adjustment
That's
based
exactly right.
on the storm.
And we keep going the same direction,
That's
i.e.
right.
west, right?
That's
we
right.
may go back east for a while, but we know we're trying to go west.
And we could come up with lots of analogies to use it, but it's a process, and we know the direction.
But I cannot reiterate the importance of having a plan, because where that comes in, and to your point about life, I really believe by learning investing at 20 years old, it drove our whole personal lives as well, because we became good at having rules, right? We became good at having, and I don't mean like rules we don't like. I mean, but it became like our decision tree rules, right? We do this, you do this. And the outcomes are pretty predictable, right? Like I'm an alcoholic, so I stopped drinking at 29, but I learned if I'm going to stay drinking at 29, this is going to end really bad in 20 years, right? I mean, it's very predictable kind of how it's going to end, because I do give, partial credit to my investment world. By then I'd invested for 10 years, and kind of actions have outcomes. And I just started applying a lot of those same rules to my personal life.
And those rules they're formulated with some experience, and that, it's the investment, not only the mistakes that you make in the path, but the opportunities missed that help you to reform a new rule and put that in.
That's absolutely right.
to put that in the plan. So if I'm a running back and I keep running over the left tackle and I keep getting the shit kicked out of me, I'm probably going to stop running over the left tackle and say, hey, let's call a different play. So, if you put some money in the market and it doesn't work, and you put some more money in the market, it doesn't work, you got to stop and say, what do I need to adjust? You just don't keep doing the same wrong thing. And over the course of time, you lose some of the bad decisions because you've learned enough, and the really good decisions blossom. And if you make a couple really good decisions, the difference between being comfortable and being wealthy, being comfortable beyond what you ever thought imaginable, it's at everybody's fingertips. That's investing today, I think.
And you have to be patient. Warren Buffett says over and over again, I'll bet I've heard him say it 50 times because I've watched tons of Warren Buffett interviews. If you take 5 stocks out of Berkshire Hathaway, he's average. And he says it. He literally says it exactly like I said. So the point becomes is what you're saying, and I want to kind of reiterate this. People have to be patient just because you're investing and it's not working. If you're buying good companies, you need to be learning and need to be sticking with the plan and know that investing is not something that gets measured on a quarterly or annual basis. It gets measured on a decade. But if you take Warren Buffett, Berkshire Hathaway, take away Coca-Cola, Nebraska Furniture, Progressive Insurance, American Express, and I can't remember what the 5th one is. Take those 5 out of Berkshire Hathaway, you wouldn't even know it. It's done all right. I mean, it would have done okay, but it's not. He wouldn't be considered great.
Well, and the beauty of Munger and Buffett and a lot of rich guys that were around or still around to talk about it is they would say one of your investing habits is investing in yourself,
yes,
in your health, in the way that you treat people,
right,
in the way that you live. It all commingles. Like, one of these things that good things happen to good people, and that just means that it's just do the right thing.
Yeah.
And it bleeds on itself.
So let's touch on the second one and kind of where it comes from is the diversification. When I say be diversified, I don't mean you will always be diversified your whole investment life. In fact, you're not going to build a lot of wealth by being diversified. You will build wealth by concentration. I had a really good friend. He was 25 years older than me. Back today, they'd probably call him a mentor, but he was just a super good friend. I just loved him to death, and we'd have conversations. And I can remember him telling me, he'd say, Tim, you need to buy S&P 500 and just leave all your money in S&P. And I said, but that's not how you got rich. I said, you bought a bunch of auto parts stores and had all your money in one place, right? And then when he got older, he diversified, right? But you're going to be concentrated just by pure nature of investing at some points in your career. But what you want to do is start thinking about how do you diversify, right? I mean, like right now, you're probably concentrated in your block franchises.
There's no doubt at one point early on, it was way too much of my net worth.
Probably almost 100% at some point, I would guess.
Yeah, I can tell you there wasn't much left in the bottom of the bucket after we closed on the first 3 offices that I bought. But,
for me, it was Schwab stock back in the 90s, so I had all my net worth in Schwab stock.
Yeah. And what and just to take your point maybe one step farther is the diversification of the core allows you the comfort and the opportunity to take on the risk in the satellites that are going to create enormous wealth. That's, so because I have this nucleus and I have it today that no matter really what happens, my world isn't going to change. But because I have that core, I could take some money in all of these parts of the market that are running like crazy and put money into it and just let it go. And not all of them are going to work out, but some of them are going to have incremental.
Yeah, if 1 or 2 work out.
They're going to work out really well. I mean,
exactly.
Pick the stocks today,
tenfold,
right?
Yeah.
Whether it's NVIDIA or what you name.
How do you pronounce the
Palantir? Yeah,
Palantir. I mean,
it's one after another, and you and I have lived through technological changes that have impacted the market exponentially. And I think of 2 things in our lives is, you and I grew up without a cell phone, and the advent of cell phones and what that did to certain opportunities of investors is unbelievable.
Correct.
We talk about McCaw Cellular or whoever you want to talk about. And then the internet. And,
Yes.
I mean, think about how that changed. There was no internet. Heck, we didn't even have an email account when you
Right.
and I met. I mean, we didn't have a cell phone. We picked up a phone out of the desk. So now we're in this third phase that's probably bigger than those two combined, artificial intelligence. If you have the core investments in your indexed funds and your 401ks, you have the opportunity to go play in these things and not worry about it.
And the part that people have to understand, so when you talk about kind of having your core 401k diversified, does what the market does, then you have your satellite investments. What debt does to people is it robs you of opportunity. And I can give the perfect example. So I want to just touch on debt and kind of how you do it. There are times when debt makes complete sense if it's done in a way that helps you grow your wealth, or it's invested in something that will typically match inflation, right? So you're buying a house, as long as it's not overly leveraged based on your income. If you're buying a business, something like that. But too much debt, junk debt, i.e., credit cards, car loans, all that kind of stuff, that will rob you of the ability to take advantage of other opportunities that will come along. Like for me, I can remember like it was yesterday, and it made me physically sick. Is I was on the floor of the commodity exchange. It was high note commodities. This would have been like early 80s, and they had these memberships that they were given to younger kids that had worked for Heinhold for 4 or 5 years, and these memberships were worth, I don't know, 20 grand or something. They weren't worth, back then that was a lot of money, but they weren't worth tons of money, but they'd spun off from the thing. Well, I had three friends that took those memberships, right? And well, today they're like, again, it goes back to you, we don't even know them because they're so rich. It's nuts, right? Well, I couldn't do it because I had debt. I couldn't
Mhm.
I couldn't take the opportunity because once they gave you the membership, you had to go make your own money. So you had to fund your account, you had to do that. I just couldn't take advantage of that. And it was so traumatizing and such a great lesson for me. I never went in debt again. I mean, once I got myself out of debt in the next 3 or 4 years, I never got there. So I was able to take advantage of stuff that came along because I just didn't have car loans and credit cards.
Well, speaking from experience, not having debt, even if it's appropriate debt, gives you a level of clarity and decision making authority of what you want to do to a level that you don't have if you're carrying the debt. And I can give you two specific examples. When I bought the business and leveraged up, I had to do it through debt. And at one point in time, I had over $1 million in debt against the business. And it impacted our lifestyle because I had to make that payment.
Right.
And now, after 20 years, the business has been paid for some time, and the house is paid for some time. And when you don't have that on your back, you have a different perspective on the opportunity that's presented to you because you have time and you don't have to worry about carrying it. You and I have talked about carrying costs. That you let it go. And we don't know when Amazon's going to pop, but we know if we sell it, we're not going to experience when it's going to happen.
Right.
And you'll get squeezed out of it. So, young guys are going to have to get a mortgage probably to buy a house. But how they manage that, do they pay it off early? Can they, not be over their heads, to do it intelligently, so they still have the opportunities to be investing all the time?
Well, and on the mortgage, I am convinced, just wrote an article, plugged it on X. So those of you who follow my PlanAssist on X and or also subscribe and comment below if you have a comment. So I do want to make a note of that so you get more of these videos. But I just wrote an article on what's the biggest challenge that people have in building wealth. And I will say it's lifestyle creep. My whole article is I am convinced, and you and I've worked with lots of people who made a lot of money, right? I mean, if you look at our counterparts, you and I have bumped into a whole bunch of people who have made a lot of money. And it's funny how now 30 or 40 years later, you go back and check on those people and how many of them don't have anywhere near as much money as they should. And if you really look at what happened is they allowed lifestyle creep to jump in there,
Mhm.
right? They allowed, like you and I kind of stay, well, we're still in the same house for the most part, right? We never kind of, our lifestyle once it got, and I'm not saying we should live like paupers and pay attention to everything. We should, if we're making good money, we should enjoy it. We should spend money, but don't let, once we find kind of that lifestyle that we're comfortable with, stick with that lifestyle for decades and then invest the rest.
Oh, absolutely. And I am sitting in the house that I bought 1 year after we were married, and we've been married probably 30, 35 years.
My point
And I
exactly.
recall specifically when you and I worked together in the first or second iteration of our careers, guys that worked for me in the business would show up in a new 7 Series Beamer and show me pictures of their brand new house. And I'm thinking to myself, this guy works for me. What am I doing wrong?
Exactly.
I
Oh
don't
my
get it.
gosh.
I
Yes.
and The houses were unbelievable. I don't know. I just kept plugging along.
Yep.
And life handed us a few career changes that it was nice to not have to worry about coming home and opening the door. That piece of, because you don't know what you don't know, it's coming. and
But we
and
do know
that's
it's coming, to your point. I mean,
yeah.
I find it, the people that work for me, I was still shocked how many of them were surprised when they got fired. I'm like, what? How is this a surprise? I mean, this is how all these careers end for that level of person. I was shocked by that. I mean, so to your point, huh?
Well, you knew I was going to get fired before I knew I was going to get fired.
But I knew I was getting fired. I never for 2 minutes questioned that I wasn't. When you get to a VP level in a Fortune
Financial
500
services
company,
firm, yeah.
you are getting fired. It's just a matter of when the new president comes in because they always bring in their own people. It's just what happens. It's not you're incapable or incompetent or anything like that. I find it just incredibly fascinating, but it goes to having a plan and being diversified because that's part of the diversification, right? I
Yes.
mean, yes, you can take some of the debt, but diversify income streams, diversify tax, have Roth and balance sheets. And when I use the word diversification, I'm not saying it, oh, I just want to have my 401k diversified. I'm saying have life diversified
Yeah.
and be aware because it's just silly to kind of think you're not going to, if you're making more than 200 grand a year, you're probably getting fired. Right? I mean, because there's going to be a finance person that's going to plug in at some point on the 14th floor of some building is going to identify your job and it's going to say they don't know you, they don't know anything about you, but that job can be done for 150 grand.
Right.
Right? I mean,
I
you and I lived in a world like that we never were like, we had conversations about it when we worked together.
well, I tell my adult children that you know, I have my MBA and I wish that they taught in college how to transition through jobs.
Yes.
And not only from how it impacts you emotionally, but having the right fundamentals financially to weather the storm, to have the safety net, the emergency fund, to know that it's coming, to plan for it,
Yes.
and then just say, "This is just another day," and start clicking the buttons on that chapter of the plan. And it just flip the switches and go get the other job. And
And,
life,
and you pray it doesn't if you have a plan you know it's coming, like I'll give you an example, and you heard me give this advice to people who reported to me, and when we were countered, I would tell you, I'm telling my people, when you get fired, and they'd say, well, I'm not getting fired. And I say, yeah, you're definitely getting fired. It's just a matter of when, and it may not be me and it may be me, but you're going to get whatever you want to call it, fired, reorged, whatever we want, whatever words we wanted to use.
my
And then
position was eliminated.
exactly whatever the word is. And then I'd say, now here's what's so important. And I can't have this conversation after the fact. So I'm giving you a heads up. When the news comes, do not talk to anyone for 3 days. Okay. Don't do any emails. Don't make any phone calls. Don't do anything. I said, and they're like, well, what do you mean? I said, well, here's what's going to happen. The first night, you're not going to sleep. The second day, you're then going to have 1 or 2 drinks. Okay. Now, all of a sudden, you're 48 hours in. You haven't slept. You have a couple drinks. Your emotions are going. Next thing you know, you're going to say something you shouldn't say, or you're going to email something you shouldn't do. And you and I have a buddy that sent an email out that was just so inappropriate. It was like, are you kidding me? How could
Well,
you go down that path?
you did share that with me. And when my position was eliminated, I went underground. I didn't talk to anybody
So did I.
for
I took
months.
my own advice 10 years later, but FYI.
I didn't talk to anybody. And what happens in life is, the world gets smaller, and there are people who I worked for or who worked for me, who I have crossed their paths again professionally in a different way. And we're working together in one way or another.
Yeah.
And here's your quote. And I can't remember when you said it because you were still working and I was on the outside looking in. It was along the lines of, do not light the oil wells on fire on your way out. It was the Saddam Hussein days. And there's no sense in burning Rome down on your way out the door. Just shut your mouth and get out and leave with your dignity. And it's always going to be intact. They can't say anything bad about somebody that takes the high road.
That's right. And it's nowhere near as personal as too many people think it is, right?
As
It's
we take it.
pure money, right? It's like the people that fired me, I was like, if you would have talked to me, I would have gave you a really strong opinion about them. But I also knew deep down that probably had nothing to do with
You're a number.
them. Exactly. It was just I'm making some adjustments for a variety of reasons. You're out. And I did the same. I did take my advice. Oh, it was 10 years after you. I went underground, didn't talk to anyone. You were probably one of my first people I reached out to, but even that was 4 or 5 months later. So anyway, so that's kind of interesting. Now the last one, this is the one we're going to spend 10, 15 minutes on, and then we'll close up. But I want to spend a few minutes on the seeking advice. And here's the piece that people really miss on the seeking advice. And I want to kind of highlight, here's how I got these numbers. What happened was, when we started Core Wealth, right? So go back to the days when Core Wealth was kind of beginning, we had no real message, right? So we were still working our way through what are we doing and even the names we use and all that kind of stuff. But even then, I was really working on what are the principles that I'm going to live with and help clients with, because I knew those were really important. And that mine, though they were somewhat transferable, they weren't universal, right? So if I looked at someone who was successful, you, me, we had similar principles, but it was still 5, 6, 7. Okay, it wasn't, you couldn't find three that you and I kind of did. Okay, so then I happened to be watching a Berkshire Hathaway shareholder meeting, and someone asked Charlie Munger what was the best investment, no, financial lesson was the question. What was the best financial question, the best financial lesson you ever learned? Okay, and Munger, no pause. I mean, so it wasn't like he had to think about it or anything like that. He says, invert everything. And I was like, invert everything. And then he goes on to tell his story about when he was a weatherman in the Army. He was in charge of telling those pilots going out on missions what the weather was. And he says, when I realized that telling them the good weather added no value to their lives, okay? Telling them the bad weather, here there's a storm here, there's ice here, there's a thunderstorm coming in, the ceiling such and such. He goes, I realized that was the value. And he goes, so I took that lesson and invert everything to real estate. And from that point on, I tried to really be clear on what's best case scenario, what's worst case scenario, what's likely in any one of his investments, right? So it was that invert, well, that's because when we're doing an investment, obviously, we think it's
Mhm.
going to be the best investment ever. You wouldn't make it, right? But if you invert that, then you say, what's worst case? Right. So if it's a real estate deal, best case it's up 20%, worst case down 10%, likely up 5%. Right. I mean, that's an example, right? So, and I know I'm setting this up long, but I want to kind of set it up for a second. So what I found though is then I started looking at people that I know, family, friends that have financial chaos in their lives. Okay. And what was so fascinating is the people who, even if they make a lot of money, they have no plan. They don't even know what diversification is. I mean, they don't have any diversification strategy at all, right? And they have no idea how to seek counsel, right? I mean, they just go do stuff, and then once they get in trouble, they go through it. Well, then I took that number, those three, put it up against people who are successful, match. People who are really successful, they don't call them have a plan, be diversified, seek counsel. But people who are really successful all have a plan. They have a diversification strategy, even if they're not diversified. And then the seeking counsel, which is where I'll kind of stop is they don't use that word. What I would see is they're very curious. You know what I mean?
Mhm.
And the bigger the financial decision, the more curious they ask. So like people will call us and say, what do you think about buying such and such? For you, it's franchises, right? I mean, and
Mhm.
they're not saying, should I buy it or not buy it? They're just coming at you more curious.
Mhm.
I mean, but they are really, really good at getting input and understanding best case, worst case, likely. And then lastly is the people who have chaos in their life, they're just terrible at it.
Well, I think of chaos begets chaos, and that we've seen people that have had big financial happenings in their life where it's an event out of the ordinary. An example is an inheritance where somebody gets a chunk of money. Now, if they had a plan, that chunk of money just kind of falls into the plan. And it doesn't become like a major thought. In fact, they knew it was going to come eventually. It usually an inheritance isn't like out of the blue. Now, I have also seen somebody who's gotten an inheritance and then all of a sudden they're shopping. And it can be for a vehicle or a new piece of real estate. And it came out of the blue. Like, when did you start looking for that? And it had, there was no plan. And maybe they're talking about a career change too. So not because this money came into the world, it's going to change everything for me. It should change nothing for
Yes.
you except make you more comfortable. So it falls into the plan. And had they sought counsel, had they had a plan, had they been able to execute on it, it wouldn't be a big deal. And the sad part is, and you and I have seen this, because nobody who inherits money values it as much as the guy who saved it. I don't see it very often, and
No,
often
exactly.
they
Almost none. Never.
they just kind of piss it away in some instances. And it's the people that do that it's a shame, because it could make a material impact. It could have generational impact if it's done right, and it falls by the wayside because of the simple concepts that the three things that you talk about. To have,
And they
to,
go, the people asking for advice, if you're not used to it, you think it's kind of demeaning, or you think that, oh, they don't know what you're doing. But trust me when I say, people who are really, really successful financially, even in their careers, they seek advice on almost everything, but they do it in a way that is not it's not obvious. And they definitely don't call it seek advice, right? I mean, or seek counsel. They don't call it that, but they definitely do it. I mean, it's no different than me with you. I'll call you out of the blue. We haven't talked in 2-3 weeks, a month. Call you and say, hey, I'm thinking about doing this. You go off and say, here's the thing to think about. I may and may not take everything you say, but if I do that with 5 people, I'll merge all 5 of those people and then I'll do something, right? So I can't go back and say Patrick's the one that gave me that advice, but your advice was invaluable because it was part of the process.
well, I think so. Let's say that it's somebody that's financially healthy, and somebody that's financially healthy, I think, has a habit that they're good learners and they're good listeners. They listen. They don't talk about themselves so much, and those people are generally good leaders. They run organizations,
Yeah.
and because they listen and they're good learners, and they take those little bits and pieces that they learn and they make suggestions. They don't tell people what to do. They tell them why that they should do it and how it's probably going to work out. And those people are good mentors and families. And some of those people are the best parents because they're good listeners and they're good learners. And one of those proverbs of parents is that ultimately your kids become your best teachers. And that really happens to parents who are good listeners. And I think it starts that what we talked about at the very beginning. It's healthy habits, not only financially, but in the way that you conduct a lot of things that you do.
Yeah, I agree. And I think, again, it almost sounds oversimplified when you say I have a plan, be diversified, seek counsel, but each one of those is extremely deep and very complicated and really hard, right? And it's something you do over a long period of time. To your point, it's not this fixed, inked planning document. It's more a living document that you're just kind of living and making adjustments as you go.
I would only say this. I would say it's more simple than complicated, but it's hard to do.
That's a
I,
good word.
I
That's a
mean,
good word.
I think it's like breaking any habits, that it's simple to break the habit, but very hard to do, to hold yourself accountable to it, to all the actions and all the things that follow. I mean, what you're asking people to do or to look at isn't brain surgery. It's not that complicated.
Right.
To have a plan, to seek counsel, what's hard about, what's complicated about that? But doing it, getting off the pillow and actually doing it, that's not so easy.
Yeah, no, that's a good, and I do find that to be true. I do find that. And so that's the three pieces I take away. Is there anything you want to kind of finish up or make a comment on? Because we did hit on those. I can't tell you how much I've enjoyed the conversation. It's so much fun. And those of you guys listening to this, it is still a conversation that we kind of went through the points, but it's not that different than when you and I have a conversation, right? So if we're
No,
talking about somebody,
no, it could be tough.
this is pretty darn close to one of our conversations.
Well, especially, we talked often when uh, Core Wealth Consultants was early in
Right,
its infancy.
exactly.
We talked about careers and lots of things in life and raising kids and health decisions and habits. But, the patience and having foresight, it's so valuable when you're looking at investments or careers or to take a step back, to not shoot from the hip. All those things that you kind of learned along the way, they apply if you just do them.
And
And
and don't you think that foresight is pretty predictable? I'm not saying we'd all go out and get in an accident, get killed or something like that, but there are actions that we're taking that's pretty predictable about what the outcome's going to be, right? I mean, whether it's my drinking, if I'm speeding all the time, I'm going to get a speeding ticket, right? If I go 15 mile an hour over the speed limit all the time, I'm getting a speeding ticket. Okay, it's just a matter of when.
well, and well, it's funny you say that because I have a chronic speeding problem, but the I will tell you that there's enough history written about the market that foresight's pretty easy to seek out
Yes.
and look at. We're gonna have some significant down days or down periods, those are the hardest. Okay, the days have been, it seems like it bounces back pretty quickly these days, but go through 6 or 12 months of it down
Yeah.
every day, and how that just drips on
Oh one, oh eight for sure.
you. Yeah, yeah. And
Actually, I one of the hardest years I ever had was 2021. I think it was. Was it 2020 or 2021 or 2022? One of those years where it was flat. I told clients, I said, I have not. This has been a tough year
well,
because
that's post-COVID.
we had zero interest rates and the markets were flat for 18 months. It is a tough to stay at it. It was not, even for someone who'd been doing it for 30 years. It was a rough period of time.
Mhm.
But I knew that I just needed to stay the course.
Well, there's no doubt. Yeah. We've learned that the benefit of being around the market for 30 plus years is you can't have a chance to enjoy it if you leave it.
And
You got to stay in.
And there's going to be something there's always a company that's starting up that's going to go up 20-fold. If people do not understand that, I'm telling you, I've been doing this for 40 years. There's always two, three, four companies. Sometimes there's more than that, like what's happened with AI, but there's still companies that will knock the cover off the ball. So there's always opportunity. It's just you need to be patient and be focused. I want to tell one last story that I think I've told you this story, but I just want to, this is a good way to end the story, even though, it doesn't necessarily tie anything together. It's just fun. I can remember having dinner with you and one of your financial advisors in the south side of Detroit. Okay. It was 2009. Okay. So 2009. So market's been down for 18 months. And I'm like you are. You and I are the same. We're just stay in the market, stay invested. That doesn't mean that it's not painful. It doesn't mean it's not emotionally draining, but you still stay with the plan. And we were having dinner with him, and he says the financial advisor is one of the bigger advisors in that market, and he says, I have a client who says the market we can start buying it again. I said, what? I said, what does he see that we're not seeing, or what do you do? And he says, and I'm going to be paraphrasing, so I may not get this perfectly right, but it was something like this. He said in 2007, this client came to him and started wiring money in and buying treasury bonds. Okay. And he was taking them out, and he owned three, four, five auto dealerships. Okay. And he starts taking the money out, Patrick, and tells him to buy treasuries. Okay. But he's taking them out of the corporation, put them into his individual name. And he says, why are you doing that? He says, I got to be prepared for going bankrupt. And he goes, so I need to get some cash out of here and kind of put it in treasuries and go through it. That's '07, right? So remember, '08 was absolutely horrific. And then the market turned in March of '09, right? So this was like February of '09, this dinner was. And And he goes, I said, so what's going on? He says, well, he goes, he's starting to send money back out, big chunks of money, and paying it off, putting it back in the corporation. And he goes, I asked the client, he goes, what is it that you see that no one else sees? And well, he goes, first of all, it's over, so you can buy the market. And he goes, but what I see is on Sundays, you can't buy cars. And he goes, and we have video, or we have video on our car lot dealers on Sundays. And he goes, for 15 years, we could predict to within a car of how many cars we'd sell the following week based on the people that looked at cars on Sunday. In that video, right? So if we had a bunch of people looking around, and he goes, in '07, we had nobody looking. In '08, nobody. One person would drive through, look at a car, but nobody was looking. He goes, about 3 months ago, he goes, that started to turn. And he goes, today, we're back to where we were in 2006, 2007. And he goes, so people are starting to relook at cars. And he goes, we're starting to sell cars. And he goes, it's over. He goes, I'm not sure why it's over, but it's over. And the reason I tell that story, and I want everyone to kind of take that away, is have a plan, be diversified, seek counsel, get input, but getting even that kind of input, and understand there are some weird kind of tall tale signs of how you find those satellite investments, right? Those companies that, you go and say Costco is different than Sam's, so I need to probably look at Costco, right? I'm using Amazon every 4 or 5 times a day. You might be wanting to look at it. All your kids are loaded up with Apple phones. You might want to buy Apple, is what you did. I remember you doing it 10 years ago. I remember you saying, I'm just buying Apple. And I said, well, what do you see?
20 years ago.
And you said, well,
my house is Apple. Yeah.
He goes, everyone in my house has Apple.
On the Christmas list.
It was everything, right?
Yeah.
And that wasn't true in mine. So I didn't buy Apple, unfortunately. But my point to finish this call is pay attention to these weird kind of happenings in your life. It doesn't mean go put all your money in there, but putting a little chunk of money is usually more visible than you think.
Yeah. Well, you buy what you know. I mean, we've seen that, and it goes back to all those Peter Lynch things.
Yeah, no, exactly.
When you drive by a Costco in the morning at 8 o'clock, it's like, what is going on? Where are these people coming from? Why are they all on gas? It's true. And there's a lot of opportunities like that. So your point is solid, Tim.
So anyways, anything you want to finish on, or just make your final comment?
Well, just to anybody that gets the benefit of listening, to know that it's good to have a comrade in arms, a sounding board, not only for financial decisions. When I took an endeavor and bought the business, Tim was very familiar with H&R Block, and we talked through it, and he helped me make some decisions that were key. The way that I've treated my employees, a number of them have worked with me for 20 years. It's because of the things that Tim and I learned together. So, and people should know that you do these podcasts because you like to help people. I mean, it's in your core that you could do lots of things with your free time. You're at a stage in life where you really don't have to do this, but you're doing it because you enjoy it. You have a passion for the market. But the overlapping umbrella and the whole thing is if you can make a difference in somebody's financial future, that's why you're doing it. So thanks for letting me be part of it.
I appreciate that. And everyone, I hope you guys enjoyed the podcast. Again, like and subscribe. And if you have any comments or something you agree with or disagree with, we'd love your comments. So give us some feedback. We appreciate it. Thanks again, and have a great day.
Thanks.